Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending May 17th, 2019. This is just going to be a brief video, not like the last one 2 weeks ago. I think it was May 5th. We're in the midst of a escalation in the trade war, and my last video on May 5th actually came out a few hours before it escalated. And if you go back and look at that video, there was a lot of really interesting stuff going on over here in April. The market was really dull and quiet, not very volatile. But there were some interesting developments that were coming into play, and the gist of that last video was some really unusual price action in other markets during this period, which was really characterized by optimism over trade negotiations. And the market was just kind of going up on that optimism, but there were some weird things going on, and the one I covered in the last video was volatility was doing some really strange things, and it was doing it from about mid-April. And I'll summarize it as this. It's a tweet from Friday, May 3rd. And this is about 24 hours, or actually about 48 hours before the trade talks publicly blew up on Sunday about noontime with President Trump's tweet. So this was, here's the date down here, May 3rd. That was Friday. They blew up on Sunday. So the SPX, the S&P 500, and the VIX 10-day correlation spike is interesting. And here's the chart here. And I said, maybe someone knows the U.S.-China trade negotiations aren't going as well as the market believes. This is early 2018 market sell-off. This is the October market sell-off, December over here. So this is the correlation spike between VIX and the S&P 500 on a 10-day basis. And you can see it's led to some really interesting activity. So this isn't the kind of thing that I speculate about. You know, maybe someone knows U.S.-China trade negotiations aren't going as well as the market believes. It's very rare for me to say something like that. You know, I'll show the evidence of charts like this, but I usually keep my opinion to myself. There was just too much building up. So it was about, this was Friday afternoon at 3:30. It was Sunday at 12 o'clock that they blew up. The trade negotiations blew up with President Trump's tweet on Sunday afternoon. And this is about what the S&P looked like at the time. So here's the S&P 500. And it started to become clear we had broadening formations. I think I covered it in the last video already in the NASDAQ, as you can see here. And that was covered in the video about 2 weeks ago. And we had the same thing happening in the S&P. And we had the same thing happening in the Dow. You can see it over here, another type of broadening formation. And even in the IWM, it was a much bigger one, a different form. So if we walk forward, you can see the SPY here. Those broadening formations broke, and we got a little bounce this week over here. So what I did was I took my IWM short off right here. IWM broke out of its broadening formation here, and I had a downside target from this little flag of about 151. So it got pretty close to that at 151.20 or so, and I took it off right here Monday morning, and the market bounced the rest of the week. So not a big deal. It was really oversold. It was probably time for that bounce. The most oversold it's been in terms of the breadth indicators that I follow in all of 2019. So I thought it was a good time to take that off. And I left some other positions open, like Treasuries, TLT. I didn't make as much as I wanted to. It took a lot longer to come down than I thought it would. But I think I made 20%, something like that. And TLT's been working really great since we opened that. So here's the daily chart of TLT. Back in here is when I opened the first trade. Closed it right up here and waited for this pullback and bought it, I think right there, one of these 2 days. And it's been doing great since. Let me jump to a 60-minute chart. Here's the consolidation. Bought it actually right here, and it's been trending up like this. I think this position's up, I don't check them every day, but I think 250%, something like that. But I could have expressed it in bond proxy sectors like utilities, staples, real estate, which have been the ones that are doing good, the defensive sectors. But this is just an easier ride. I prefer this over stocks. You know, it's been nice and simple. I don't get up in the morning and wonder. So here's the S&P 500 daily from 2019. This is really the shallowest, most forgiving uptrend line I can draw. A lot of you know, these change as the market develops, but a lot of people use really sharp ones and say, oh, look, you know, the market broke down over here. This is really the most generously drawn trend line. And yes, it did break down. And this is that little broadening top there. So here's what's really interesting. We have a trend break. We have this broadening formation as volatility and currency markets, bond markets, we're saying something's going on here. And this is kind of demonstrating the fractal nature of markets. So you see this small broadening top here. I'm going to kind of back out and show you a much bigger picture of the S&P 500 because I've suspected this is a top formation the last year and a half or so. Okay, so this is a weekly chart, the S&P 500, covering the entire bull market from the 2009 low over here. A couple times where we almost turned lower here and here. The Federal Reserve came and bailed the market out. That rightfully probably would have been a market top. In any case, this is from 2018, that first sell-off in February. Here's the one in October and December. And here's the rally in 2019 and where we are now, breaking that trend line I was talking about. So if we look at this closer on a daily chart, there it is. Here's the sell-off in February. Here's the one in October, December. Here's our rally, our central bank dovish pivot. And here's that small broadening top on the 60-minute chart. So one thing about broadening tops, I'm going to show you on the 60-minute chart again. And let me just back it up a little bit so we're just looking at that broadening top. They tend to have 5 pivots, so you'll have 3 touches of the upper trend line and 2 in between of the lower trend line. So how you define a broadening top or a megaphone top is that you're making higher highs and lower lows. So you have the lower lows here, you have the higher highs here, you have pivot 1 here, 2 here, this is 3 up at the top trend line, there's 4. The 5th pivot should have hit this upper trend line, did not. Okay, it made a lower high over here and then broke down below. So now if we go back to that big picture daily chart, and there's that little pattern I was just showing you, we have the same thing. We have 1, 2, this is 2 here, 3, 4, and this is 5. And guess what? That little small 60-minute broadening top broke down at 0.5 just below this upper trend line. So I think there is a strong case to be made that this is a top of some sort because it's just, this is a bull market. This is what a bull market looks like. This is too much volatility. So I really do think that this is a top. I wasn't sure if it was going to be some kind of odd head and shoulders top. And all head and shoulders tops actually start as broadening tops. So that's a little interesting tidbit for you. In any case, very volatile this past couple weeks. Go to a 15-minute chart real quick. Here's the broadening top again. 0.5 failed. Broke the very moderately drawn trend line of 2019, broke below that. Here's Monday where we closed the IWM short, and I'm going to reopen that and bounce back into the lower trend line, or back tested this kind of broadening top formation. So I'll show you what I'm looking at going forward in the next week. To me, this is just an oversold bounce. You can look at it another way, like a small flag. It's not a true bear flag, but you do have the breakdown here, which would be the flagpole, and the consolidation here, which would be the flag. But in any case, I don't think it's a true bear flag. I'm just saying that this lower trend line here is probably one to keep an eye on. So that is Monday morning's low, and over here that is Wednesday morning's low. And you can see since we kind of broke down, it's been a pattern of lower highs over here, lower high, lower high, lower high, and lower lows. So lower low, lower low, lower low, lower low, lower low. And here's the consolidation of the last week. So one of the things it did this week was hit the 50-day moving average, and that's kind of just a reversion to the mean on a correction. Pretty normal. I think we could come up to maybe this 2900 level, and then you'll want to watch this kind of 2850. This will be a moving target because as we move forward, you will see that the trend line will kind of gain. It will move up with prices here. And you can kind of see another pattern here that's been going on, which is bad news comes out overnight about the trade talks, and the market will gap down, and then they'll release optimistic news in the daytime, and the market will rip higher in the daytime. So it gaps down overnight or in the morning, rips higher in the day, gaps down, rips higher in the day, gaps down, rips higher in the day, so on and so forth. So it's a very frustrating market in terms of trying to trade these little small whips. I'm just looking at it from this perspective. I'm trading the lower highs, lower lows, letting this correct, and I'm going to re-enter my short position. The only reason I took it off was because it was expiring Friday, and I had a profit in it, and I thought the market was very oversold as of Monday morning. So I'll be re-entering that. Maybe if we can get up to this 2900 or above, that would give me a good re-entry point. And then on the downside, I would keep an eye on the March 25th low, which is right here. This is after the Federal Reserve big growth scare. Here's the March 25th low. It's about 27.85 for the S&P. So right now, this is the biggest, baddest correction of 2019, but it is just a correction. here we are back to that daily chart. So correction here, correction here, correction here. Biggest, baddest correction of 2019, but it did not break this March 25th low. So that's the reason I would keep a close eye on that level at about 27.85. We break that low there, and it turns from a minor downtrend correction to something uglier. And since we do have broadening formations on the daily charts, and that fifth pivot has not been hit, it's definitely time to be aware. These 10-day correlations are pretty unusual. You don't see them a lot. Here's the last one before the trade war actually exploded again, or the trade talks exploded. And you can see we've had some really big, more than just corrections. So the February sell-off and volatility explosion, the October, December sell-off, and now this was taken as of, I think, May 2nd, so it doesn't reflect the last couple of weeks of price. But as you can see, now we're starting to get that as well. So unusual events that weren't depicted by the equity market. Doesn't matter how many indicators you throw up on a price chart, they're all coming from price and volume, and price and volume did not show this. It was volatility, it was currencies, and it was treasuries that showed these changes in the market. Much more sophisticated markets for the most part, except for volatility. And they were really waving that flag. Go check out the last week or 2 weeks ago, the video I posted on the volatility section, this 10-day correlation. So I'm going to leave it off there. Have a fantastic weekend, and I will see you next week.